Thanks, Mark. So what we're going to talk about reshaping today is the wild ride of small cap alpha. And often people are trying to look out to the future and figure out what does the future hold. And if you want to understand what the future holds, the best person to talk to are the people who are shaping the future. And so Jeff Bezos from Amazon is often asked the question, Jeff, what's going to change in the next 10 years? And he says, look, that's an interesting question, and I get asked it all the time, but what people never ask me is what's going to stay the same. And he said, I posit that is the more important question because what is stable through time actually allows you to build a more sustainable business and a more sustainable strategy as an entrepreneur. And that's what they do at Amazon. So the quote here is Jeff Bezos talking about what he believes his customers value today and what he believes that they will value in 10 years' time. So he says we know that they want low prices, fast delivery and vast selection today, and we know that's going to be true in 10 years' time. So even though they're in the technology business, they're focused on things that are stable through time. At the same time, most other people are trying to figure out what's coming next. And that video that was played at the beginning of all of these sessions showed just how much noise there is in markets and people trying to figure out, what's coming around the corner and what do I have to react to. Some of the greatest technologists in the world are saying, forget all that noise, focus on what's going to be consistent and build your business on that. And so when we ask ourselves the question, what's not going to change for our clients? What's going to remain true for what we need to deliver to them today and in 10 years' time? We think that more consistent alpha at lower fees is probably going to be true. We can't think of an active fund investing client who's going to want lower alpha in the future. We can't think of people who actually want less consistent returns. They want more consistency. And we actually can't think of too many underlying investors who don't want lower fees so they can keep more of the return that an active strategy generates for them. And so that's what we're trying to do at Longwave with our more diversified, quality-focused approach, is to deliver this more consistent alpha at lower fees. And although it's not common in the small cap market today, we do believe it's possible, and we've been investing this way for more than 5 years, and we'll show you some of those results. Now, this slide shows the alpha journey of a typical active small cap manager. Now, we haven't named them, but they're probably a pretty well-known small cap manager. And this is the sort of shape of returns that you see through time from active managers. So the alpha is pretty easy to see. At the end of the day, up here, about 2% per annum excess returns, net of fees. And that puts this fund just inside the first quartile. So actually, this is quite a well-performing small cap fund. But you can see the volatility in the ride that investors endure. In early 2020, you've seen 4 years of alpha disappear in the space of 4 weeks. And then in 18 months after that, the fund outperformed the market by 50% and was probably in the top decile of funds for performance. This is the sort of wild ride that people have come to expect for active small cap managers. And you can measure that by the tracking error. That tracking error number there of 10.7 is a measure of that volatility of alpha performance. We're simply looking at excess returns here. We know that everyone hires active managers to beat a benchmark. So we've taken the benchmarks out. We're just looking at the value that the manager is intending to add. So that's not unusual. And the information ratio of 0.2, well, that's a measure of the signal or the alpha relative to how much volatility you experience along the way. Now, that's, of course, not the only pattern you'll see in the market. We've put a few more on the screen here. And I don't intend to go through all of it, but really what we're trying to show here is that on the axis of high alpha to low alpha, the outcomes that managers produce, we clearly want to be in the top half of that chart, right? What's the point otherwise? You want a high alpha manager. And if you can, we would argue you would like to be in the top left quadrant, right? Why would you take the unnecessary volatility of that ride if you didn't have to? But that's not a very easy thing to achieve, and it's not a very common fund structure. Most of the funds look like our sample fund over here with that more volatile path. And so we ask ourselves the question, why is that? Why are so many funds so volatile in small caps? It's because there's a belief that you have to be concentrated in order to achieve the alpha outcome. And we hear this all the time from clients, I'm looking for a concentrated small cap manager. And lo and behold, most of the small cap managers in the market are concentrated, and the rationale is that's how you generate those returns. We have to be concentrated to generate the returns. Which is interesting, because you can test that. You can run a test to say, do more concentrated managers outperform? It's hard to do in Australia because there are so few funds, but we have run this analysis in the US. So these are 632 funds from the US Morningstar Small Cap Active Manager Survey, and we've grouped them into buckets of most diversified to most concentrated. And this goes back over 22 years with a sample size that we just couldn't get here in Australia. I don't think you can say that diversified is better. I don't think you can say that concentrated is better. The median returns that these fund groups deliver are actually pretty similar through time. What you can probably say is that the variance or the width or the outcome of the range of returns you might get is wider in concentrated funds and probably more extreme in the bit you don't want, which is the downside tail down here. Now, this is a survivor bias-free database, which means it includes all the funds that have since been shut down. No one produces 63% per annum negative returns for too long and stays around. So many of the funds in these tails no longer exist, but as an investor today, that's the risk you obviously take. So we don't think that you need to be concentrated in order to outperform. And it sort of makes sense, right? Warren Buffett was a concentrated investor. He's a concentrated investor. He did very well. Peter Lynch was a very diversified investor. When he ran the Fidelity Magellan Fund, he often held up to 800 stocks, many of them small caps. So it's not a panacea, the number of stocks you hold. It's got to come down to the skill of the manager and the ability to find some difference to the market in order to outperform. And so this is the Longwave performance track record. Net excess return goes back to when we started the strategy at Schroders, and then we moved across to Longwave in conjunction with Pinnacle. And you can see, again, it's the same style of chart we've seen before, the cumulative excess return through time, without the large ups and downs. So the tracking error is much lower, net excess return of 3.7%, and through both value and growth markets. So we believe it is possible to deliver more consistent alpha. Our fund structure has been set up to also have lower fees because we do believe that's what clients are going to want today and in the future. So it's set up with a base fee only model that reduces over time as our fund increases. So that's what we've set out to do. I thought in the last few minutes I'll give you a couple of examples of the sort of companies we own and the backdrop we're faced and why we believe quality small caps are the place to focus in order to generate these sort of outcomes consistently. So the obligatory macro slide. On the left we can see core CPI today versus what it was in the early 70s. And this chart starts the year I was born in 1973, and we've never seen a market like this in my investing career, and barely in my lifetime of the inflation we're faced with at the moment. Now, will this inflation continue? Will it look like the 70s through to the late 2020s? Who knows? We don't build portfolios with macro inputs, but it's a lot of change in environment that we haven't seen before. What we're seeing on the right-hand side is the cost of debt. Now, this feeds directly into the balance sheet risk of the companies we invest in. This is something we can remember because we've been investing since the early 2000s. And prior to 2012, we didn't have this situation where there was a continuation of falling interest rates that were boosting earnings per share and markets did not care about balance sheet risk. So that's something we're very mindful of. Sorry, let's have a drink. Sorry. In terms of stocks, I'll cover two stocks and then we'll wrap up. So Mainfreight's the first quality business I wanted to talk about that's indicative of the sort of companies we invest in. They're a New Zealand-founded global logistics company that's compounded revenue at 14% per annum and EBITDA at 20% per annum over the last 20 years. Now, they started in 1978, just in New Zealand, and they have a very particular culture at Mainfreight which drives this growth. It's a culture of execution and excellence. It's about investing in their people and promoting from within. These guys are doers. They're not sort of academic MBA types. And so they've gone from being a very small Australian-New Zealand business back in 2002 to having a global footprint now where the size of their business in the Americas is currently about the same size as their New Zealand business in a market that's 50 times the size. So 45 years into a 100-year journey, these guys still have a lot of runway in front of them. If we look at the returns that Mainfreight have generated, you can see they're 27% per annum for the past 20 or so years. And the thing that is consistent within the Mainfreight business is their culture. So how can we be confident that they'll continue to generate returns at that rate, that they'll continue to deliver the performance in the business? It's because the same culture is enduring as they grow out into these global markets. The second stock to touch on is Imdex. Now, Imdex is a mining technology business. It's a real business, real revenues, real earnings, real cash flow. But it's a business that's invested almost $100 million in R&D over the past 5 years in new products to grow their business into new markets. And if we think about how the market values a company like Imdex versus some of these tech hope stocks in the market today, there's a massive disconnect. There's a big disconnect between the doers, the companies who are actually innovating and executing, versus those that are promising and are built off hype. So Imdex is investing a lot in their future growth, and this is where we think it will turn up. We think what we'll see in the very short term is an improvement in their mining technology as a percentage of their revenue, so this is the high value outcome from their investment in R&D, and that will lead to an expansion in their EBITDA margins. But strategically, longer term, it'll also potentially expand their market size by 4 times, doubling from existing into new exploration, and then from exploration into production. So they're 2 examples, Mainfreight and Imdex, of quality businesses that are probably off the radar for most people, that have long runways of growth in front of them, that can help continue delivering the sort of returns that we've generated so far to date. And so just to wrap up, to generate more consistent alpha at lower fees, we don't need to overcomplicate it. Buy good businesses with high ROEs and strong balance sheets. Don't pay too much for them. Diversify your portfolio and capture the growth in long-term returns that small caps offer investors without taking that wild ride. Thank you.